Creamer Media's Mining Weekly is interviewing AmaranthCX director Paul Miller on what can be done to reverse South Africa's declining public market system and to attract more listings to the Johannesburg Stock Exchange, the JSE. Hi, Paul. It's great to chat to you once again. Following last month's annual general meeting of the JSE, are any new steps being taken within our public market system to stimulate more retail investor activity on the JSE?
Martin, I'm afraid I don't see much happening. There is a root and branch rewriting of the JSE's listings requirements, which is very welcome, which includes a more graduated regulatory regime for different size companies. So smaller companies will have lesser requirements, and as you proceed up the index to the very large companies, they will have the highest level of regulatory requirements, which I think is a very welcome move. But in terms of retail participation, we've not seen any material changes. And I think that's not really the remit of the JSE itself. It's the fact that our policymakers at National Treasury are very passive on this issue and don't seem to think there's a problem.
And why is the attraction of small and medium companies to the JSE important for the JSE?
Well, there are two things we're talking about here, and perhaps they're two sides of the same coin. In order to have small and medium companies come to the JSE, they've got to be confident that A, they'll get a good rating on their share price, but B, they'll be able to actually raise capital. And then on the other side, in order for smaller companies to raise capital, they need a very much more diverse investor base, which includes retail and other non-institutional investors. Now, you need both, and they're kind of mutually reinforcing. The more activity you have among small and medium companies, the more investors you'll attract, and the more investors that you attract, the more medium and smaller companies you'll have. Now, we've not seen even an in-depth analysis or diagnosis or understanding or report or study into this issue from either the JSE or National Treasury, except just last week, we saw the South African Reserve Bank come out with their financial stability report, and for the first time, an official regulator in South Africa has expressed concern on the state of our public markets and how shallow those markets have become. And that's a welcome development, because it's been very frustrating to have National Treasury simply say there's nothing to see here, there's no problem, which is quite different to what's happened in other markets. For example, in the UK, which has also seen a decline in the number of listed companies, 60% decline in the number of listed companies over the last few decades. They've pulled out all the stops to investigate the issue, implement reform initiatives, really try and get into why it is that our public markets are not performing as we would like. And we're just not seeing the same energy in South Africa. It's almost like National Treasury is not interested.
And should the entrepreneurial end of the JSE be represented on the board of the JSE through the appointment of small end directors?
Well, that's a good question. And I mean, we have to step back a bit. The Jacobs Committee report of 1992 really set up the scaffolding on which our whole regulatory environment has developed. The way we regulate our savings industry has developed over the last 3 decades. And there's no question that the big beneficiaries of the structure of our savings industry have not been the savers themselves. It's been our very concentrated, dominant financial institutions. Now, there's a very valid argument, I believe, to say that the indirect or unintended consequence of this concentration of our financial services industry and the high retail investment fees that they charge has actually caused this issue with the JSE. And yet, if you look at the directors of the JSE, and they're very experienced, and I'm not casting aspersions on them at all, they're very experienced business people. There's no question that they belong as directors of public companies, but they all come from large financial institutions. Those very financial institutions that have participated in extracting rents from our market and in effect driving out retail investors from direct participation in the JSE. So we have directors of the JSE who all come from those highly concentrated major financial institutions. How can they possibly know what it means to raise money for a junior explorer? How can they possibly know what it means to try and run a stockbroking firm in a declining market? They've got fantastic experience running major financial institutions or working in major financial institutions. They've got no experience of what it means to either run or serve a company in the lower end of the stock exchange. And it's not to say that they're not great directors and they need to be there, but the JSE also needs to look at who else needs to be on that board. And that should certainly include someone who's got experience at that lower end, not necessarily as an entrepreneur, but perhaps as a consultant or a service provider or someone who's actually tried to raise money in the primary market. I don't see any of that experience in the current board, as worthy as they all are.
And is the absence of directors with small end and medium end experience one of the reasons why small and medium companies are not being attracted to the JSE in significant numbers?
You can't arrive at that sort of causal distinction. I mean, the fact is that the JSE's own employees tend to also come from big business. In fact, it goes beyond that. The JSE's advisory committees are largely staffed by people who come out of big business. The JSE's employees, when they do come from outside the JSE, tend to come from the financial services industry, the large companies in the financial services industry, and the JSE's board all come from the large financial services industry. So it's not surprising that the JSE itself has battled to attract smaller companies to the board. It's not to say that any of those people in and of themselves aren't worthy of their roles. It's just to say there's no diversity. And I mean, if you think that the policymakers, the regulators, the consultants, everyone who makes their living in financial services in South Africa tends to serve the large end of the market. And we see that replicated again and again and again. And really, it's not surprising that the JSE is very similar. We just don't have fintech entrepreneurs or founders or the kinds of people who perhaps would be a bit more disruptive involved in these organizations.
And looking holistically, Paul, how should the public market ecosystem that sustains public markets globally be uplifted to a greater extent by the JSE as well as by government policy?
Well, look, I think the JSE's done a lot. I don't think they've been able to engage in a meaningful way with the policymakers. The fact that National Treasury, the FSCA, don't see a problem with the fact that 2023 was the worst year on record for new listings and primary capital raisings on the JSE. More than 60% of the gross market cap of the JSE is now secondary listed companies that are served by financial sectors elsewhere in the world. Nobody thinks that this is a problem. So that's the first step we need to get to. And that's where the breakthrough has been the fact that the Reserve Bank has finally started publishing some information. In fact, they announced in their review of last week that they are doing further research and further work to better understand why our public market has become so shallow. And in fact, to be fair, they tend to concentrate on the debt market rather than the equities market, but they did include the changing structure of our equity markets in their concern. If the JSE can't get it right to get attention on this problem and get any action taken, if National Treasury is entirely passive, if the FSCA says there's no problem here, at least the Reserve Bank might be able to pay some attention, spend some money, do some research, and come up with some solutions for this problem.
And in the event of a listings boom, and we hope another one takes place at some stage, are there sufficient people, investor relations, investment banking services, and advisory skills to cope with an upsurge in the number of listings on the JSE?
Well, that would be a quality problem to have, wouldn't it, Martin, if we could? Look, there are lots of generalist corporate financiers out there, and quite frankly, they would have to get into their rule books and swat up on how to do it again. The fact is that to sustain a career in equity capital markets in South Africa, you have to be a generalist in many respects. Those people are out there and they could change their focus and get involved in new listings and capital raisings, which would be great. So I think we don't want to overstate the problem. There are lots of financial services professionals out there, and they would train up quickly. But there would be, certainly, if there was a massive boom in listings, there would initially be a shortage of skills, but I think we could manage.
And to what extent could a well-supported South African public market system create the inclusive economic growth that South Africa so desperately needs?
Well, that's the strange thing, Martin. To some extent, our public markets in South Africa are way more developed than we are as a country. So we've got the 40th largest economy in the world, but we've got the 20th largest public market. So it's a superpower. It's something that we do much better than on a relative basis than a lot of our competing countries. And that's fantastic. But the idea that we can just neglect it, we've got this services economy that's built up around financial services. It employs lots of people. It's growing ahead of the rest of the economy. At its heart is the public market, and yet we're allowing it to wither. And as we've seen, our logistics infrastructure, our power infrastructure, all these things have been allowed to wither. And yet here, the JSE, or the public markets more generally, which is fundamentally a private sector initiative, just hasn't been able to address these issues. And that's disappointing.
And can you name some reforms that the JSE has introduced in recent years that have been successful in increasing activities on the exchange?
I've been around for quite a long time, Martin. So there indeed, the JSE's done an enormous amount to try and address these issues. And each individual initiative has been somewhat successful. But they still haven't been able to change the trajectory. What's fair to say is it's actually beyond their remit. It's the policymakers that need to pay attention to this problem. The evidence is in. Everything the JSE's done, even when it's successful, has not been enough to change the trajectory. So if we go through it, the introduction of the ALTX was successful. The introduction of real estate investment trusts was successful. We've got special purpose acquisition companies. Some of them have been listed, perhaps a bit less successful. Inward dual listings, the JSE lobbied hard. 65% of the gross market cap of the JSE is now inward dual listings. So we've got companies that actually have no operations in South Africa or negligible operations in South Africa that are listed here. So we've had these pockets of success, and we've had 2.5, I call them, listings booms in the last 30 years. But none of that's been sufficient in itself to reverse the trajectory. It's not like other markets aren't battling with the same problems. That's true, but at least in other markets, action is being taken. In South Africa, it's all left to the JSE, and yet they don't have the levers to make a difference. We really need to understand why it is we have such low levels of retail participation in our market. Look, it's not the only thing we need, but that's one primary requirement for a successful market, is a much more diverse investor base participating directly in the market.
And what is your view of the introduction of the JSE's private placement market?
Well, I think we need to be a little bit more circumspect about how successful that market has been, because I've not actually been able to establish from what the JSE's said publicly exactly how many companies actually have raised money on that private market. So they talk about having mobilized capital and having attracted people looking to raise money. I don't know, and it's not easy to tell, how many actual issues of shares for cash there have been in that market. The JSE knows that it has to diversify its revenue sources, and I think it's important to understand that private markets are important. I don't think we must give up on public markets and decide that we must just throw our lot in with private markets. Public markets serve a social good. They allow us to price equities. They give us price discovery. They allow pension funds somewhere to put the money. Nobody has more disclosure than public companies. If we allow everything to go private, we're also allowing everything to go dark. So I think we mustn't give up on public markets. They're too important.
And when it comes to mining exploration, should a cadastre system that provides efficient administration remove the excuse of National Treasury to refrain from introducing taxing incentives like those that stimulate exploration in competing mining jurisdictions?
National Treasury is pretty explicit on this issue. They're saying they're not going to pick industries to benefit from tax incentives. And I've got some sympathy for that point of view. The idea that bureaucrats should decide which industry deserves help and which doesn't. Because, I mean, if you are a farmer or, someone in the energy sector, you're saying, well, why can't we have something? So I think I have some sympathy for that view. However, there is an existential crisis developing in our mining industry in that it takes 10 to 20 years from discovery to development of a new mine. And in 10 to 20 years, a lot of our current mines are going to be at the end of their lives. So we owe it to the future to encourage more exploration today. One of the instruments that can be used is a tax incentive for exploration, but there are lots of others too. I mean, we could invest in our regional geophysical surveys and make that data public. We could simply improve the administration of our prospecting rights beyond just the cadastre. I don't think a cadastre is a silver bullet on its own. I don't think a tax incentive for exploration would be a silver bullet on its own. It's a combination of different factors to encourage exploration. What I would really like is for National Treasury to appreciate that they discriminate against direct investors in the stock exchange. And we're not asking for a tax incentive. We're asking for equal treatment between institutional investors and direct investors in the stock exchange in order to encourage retail investors to participate directly. And that's not a tax incentive. That's just introducing fairness into the public markets, which you don't currently have.
And finally, Paul, what in your view should be the biggest takeaway from this interview?
The biggest takeaway, I think, and it's something I've been battling with, is this idea that in every other major financial markets, the public market itself is recognized as being a competitive edge for a country. Countries with good public markets recognize that that's how you compete as an economy against other economies, and that you need to constantly improve the competitiveness of your public market, and you need to be looking at the structure, form, substance, regulation of that public market all the time. And yet, in South Africa, the evidence is in. We are in decline. The number of public companies or listed companies is declining year after year after year, and yet we get no policy response at all. You get indifference, and there's nothing worse than complete indifference from the National Treasury as to the state of our public market.
That was Creamer Media's Mining Weekly, speaking to Paul Miller, the director of AmaranthCX,